Welcome to the Learn podcast, where first you learn, then you drop the L, and then you earn. I'm your host, Dean the Wealth Coach, and today marks the 25th episode of the Learn podcast. I am 1/3 of the way there to hitting 75 straight days of podcasting. I'm very excited to bring you guys this episode today, where today we're talking about business cycles and how it relates to the stock market. So, what is a business cycle? So, a business cycle, think of it like a roller coaster, where first you go up, 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 all the way to the top, and then what happens? You come down the roller coaster, right? So, that's how I want you to think of the stock market. It has different cycles. Sometimes it's up, sometimes it's down. We all know, we all know that nothing goes up forever. What goes up must come down, right? But with the stock market, if you can identify what cycle it's in, it makes it easier for you to make a better decision as to what you're going to be investing in. So with the market cycles or the business cycles, there's 4 cycles. So the 4 cycles are the expansion, the peak, the contraction, and the true or tro. I don't know if I'm pronouncing that right, but it's TROUGH. So with the 4 different cycles of the business cycle, market cycle, whichever you want to call it, the expansion phase, that's when the economy is growing and is doing well. Banks' interests are usually low, people are borrowing money, everybody's working, and they're just spending, right? Then you have the peak stage. So that's at the highest point of the economy. The economy is doing great, but interest rates are a bit or too low, and it's time to slow down the economy. Like, just too much is happening, right? So during that time you need it, or before during that time, it's everybody is like experiencing what they call euphoria. We could also look at like this thing that I got introduced to called the Wall Street cheat sheet, and it literally gives you the cycle of how people's emotions are in the stock market. And that's where the peak phase is, euphoria. It's like nothing can go wrong, everything's great. I can just continue spending money, doing whatever I want. However, when things hit the fan, you have what we call the contraction phase, or also known as the recession, where it's like the government says, all right, a lot of money is being pumped out, but now we got to bring things back to normal, and inflation is relatively low, but now they gotta fix all that, right? So what they do is they start to raise interest rates. Consumers, at that point, people are starting to lose jobs. When people lose jobs, money's not being poured into the economy. So that's where a recession begins to happen. That's when you're just like literally coming down the roller coaster. Some people ride the wave and like, yeah, it'll end soon, but it's hard to predict anything in this world, right? Then you have the true, however you want to pronounce it. That's when the economy is starting to grow again. So places are hiring, people are starting to spend money, interest rates are starting to get low again. So that's pretty much the 4 main cycles or the 4 business cycles that the stock market pretty much follows along with. And each of those sectors, I'll let you know which stocks usually do good. So in the expansion phase, you have technology, communication, consumer discretionary. So what consumer discretionary is, think of things that you purchase. Think of things that you want and not really need. So for example, it would be Netflix or Disney or Nike. Those are things that you just want. It's not necessary that you need these things. You have additional income or more income coming in, so you're spending your money, or interest rates are low. So let's say you want to do some investments like real estate. Interest rates would be low, so it'd be a great time to purchase real estate. Then you have the peak. So that's the top of the roller coaster. So that's when materials and energy and financials are doing very well, because a lot of people are borrowing. Well, with financials especially, a lot of people are borrowing money because of the expansion, because the economy is growing, right? And now we're at the top. So that's during the peak. Those are the sectors that relatively do well. Now, when the economy is like there's uncertainty in the world, or a lot of people are borrowing and nobody's working, that's when we hit the recession stage. In the recession stage or contraction, utilities, consumer cyclicals, and healthcare tend to do better. So consumer cyclicals is the opposite of consumer discretionary, or I should say consumer defense. So those are things where it's your necessities, like you need to get by. So that would be like your funny enough, Amazon's included in there. Pepsi, Coca-Cola. What was the other one that I had? There was another one. Costco. So those would be like on your consumer defense side. Those corporations, their sales and earnings usually maintain the same during both economic upturns and downturns. Then you have the TRO or true. I'm going to be saying that weird all through this segment, or let's call it the recovery stage. So that's when things are starting to get better. Real estate is relatively low because nobody was buying in a recession. So it's like, okay, now the economy's picking back up. So let's say you go on the top hill, you come down the roller coaster. Now you have, that little tiny hill that they usually have before the ride ends. That's where like the recovery comes in. So industrials and real estate really do well in those sectors. So a few things that I want to leave you or let you guys know about is how can you use this information to make sound decisions with your investments. So what you can look at as indicators is GDP. So that's gross domestic product. Let me just make sure GDP. And that's, yes, gross domestic product. So that measures the monetary value of goods and services. That is, goods and services, those are bought by the final user. So that's what gross domestic product is. So anything that you buy goes towards the gross domestic products, the amount of money that we pour into the economy. And it lets us know if the economy is growing or shrinking. Next, you have unemployment rate. That shows how many people are out of work. If your economy has a lot of people that are not working, then no money is being cycled through the economy. So if it's low, or if the number is low, that means the economy is doing well because people are working, people are making money. But now if it's high, that's not a good thing. So that's when like you're in a recession, and a lot of people are losing jobs. No money's going through the economy. Then you have consumer confidence, and that measures how optimistic people are about the economy. Looking at those indicators can give you a sense of what phase of the business cycle the economy is in. So those are the three indicators you want to use when looking at the stock market in whole. Next you have is how can investors use their... So with you understanding that information, I don't even know how long this... Oh, we're at 9 minutes. Depending on what phase... So depending on what phase the economy is in, you would use the information that I provided before as what you want to invest in. So if you're in the expansion or the recovery stage, then you want to look into stocks and real estate because their prices are going to be relatively low. If we're in the contraction or recession phase, probably bonds and cash would be your best place to put your money. So with all that information said, the first thing you want to make sure you do is identify what cycle or what stage of the business cycle that we're in before purchasing or before getting into the stock market or any type of investment. Look at the economic indicators, the GDP, the unemployment, and consumer confidence. So hopefully with that explanation of the business cycle, it can help you with making a better decision when it comes to purchasing in the stock market. I'm your host, Dean the Wealth Coach. Thank you for tuning in. Don't forget to hit the subscribe button so you can stay up to date with the channel. And I'll see you on tomorrow's episode 26.